our friend and the Chief Research Investment Officer of Morningstar, Daniel Kemp, to have our final investment firm discussion for 2025. Dan, how are you? Other than very festive, we see the decorations behind you. It's really good to see you.
Lou, it's great to see you too, and thanks for having me back. Yes, it's getting that time of year. It's a wonderful time as we approach Christmas. It really is.
Agreed. And looking forward to a new year. We have plenty to cover. As I've said to everyone at the beginning of these meetings, we'll take about 20 minutes of their time, so not too long. And I'll arrange the conversation. We're going to discuss bonds and interest rates. They go together. Maybe a little touching on the U.S. Fed, because a lot of people have a lot of opinions right now about the Fed. Foreign equity. Now, if you don't prefer the term foreign, we could use equity outside the United States, okay, or international. That's not necessarily international. And then we have an income discussion, large company stocks, but really concentration risk that we're going to talk about there as well. So let's start with the bond conversation and the interest rates. If you would, the outlook from Morningstar that you're applying in portfolios right now, not necessarily in bond holdings, but even as it applies to stock holdings, Dan, where's the risk of interest rates? How does it impact stock investments? And then, of course, touch on bonds for us, please.
Yeah, thanks, Lou. Well, as you know, in the short term, markets tend to be driven by stories. People love to extrapolate what's currently going on and attach stories to every move in markets. And the story that people are focused on at the moment is that falling interest rates are good for stocks. So, of course, as interest rates decline, then the burden of your interest payments is lower. We all know that from our own borrowings. So that frees up capital to invest or to spend. That tends to spur the economy. Hence, people think that's good for interest rates, good for stocks rather. But it's not actually that simple. Of course, one of the reasons that the Fed reduces interest rates is where they see downside risk for the economy, where they're concerned about what the path of the future economic growth is going to be. It can act as a warning sign as much as a trigger for growth. And so as we think about these latest falls in interest rates, and remember, this was a really contentious cut by the Fed this week. They're more divided than we've seen in a while. Then it's really important that people don't attach these stories to what's going on and see that as automatically good for stocks. It's likely to be far more complicated. So the best thing to do is just ignore what the Fed is doing month by month. That's really noise as far as investing is concerned, and think about what the valuation of these stocks are and the long-term prospects for the growth of the earnings and the profits in these companies. So the less we focus on what the Fed's doing right now, the better we're likely to be.
Okay, and I have to add two things to that. The first, I made a note while you were speaking because you triggered a memory of so many things that I read. The stock market is not the economy.
Yes.
And it's very, very difficult to separate the two because they're correlated, of course, but the stock market is a predictor, if you will, of the economy. And as you mentioned, lower interest rates would be a prediction that things are going poorly in the future for the economy. That's not the case. And the second part of it is Harry Dent, the economist from many, many years ago, the great boom ahead, and then he made another prediction that was really accurate. Talked about interest rates being like candy for the stock market.
Yes.
And candy makes you fat, and that's not a good thing, kind of deal. So those two things I think are excellent to be reminders about the Federal Reserve and their role. It's not to make the stock market go up. It is to manage an overall economy that touches all over the world. And leading to bonds. The bond conversation is quite a challenge right now, Dan, because we want income from our bonds. So you're lowering interest rates. You could be lowering income. Your short-term bank rates, which are much higher than they were a couple of years ago. I know people like that. We talk about that. But the challenges in the bond market are real at this moment. Valuations of bonds. So meaning if I buy a bond for $10,000 and they lower interest rates, well, the value of my bond just went up because my interest rate may be higher. Well, if I'm holding old bonds, it may be lower. I may be seeing a valuation reduction. So tell me how Morningstar is approaching bonds right now inside portfolios.
Yeah, sure, Lou. So, I mean, the most important thing with bonds is to know why you own them. You touched on it there, talking about income. And people often get confused about the role that bonds are playing in their portfolio. Now, what we know is that if you promised to invest without touching your money for the next 15 years, then the best thing you could possibly do is just buy stocks and forget about them. And then you do really, really well. But no one does that. And so bonds are often used as a diversifier in portfolios, because when stocks go down, often the price of bonds goes up, and so they act as a bit of a brake on the portfolio, which is frustrating if equities are going up, if stocks are going up, but can be comforting if stocks are going down. So that's one reason to own them. The other reason to own them, of course, is that stability of income, as you say. But that stability only applies in terms of the actual dollars and cents you're getting from a single bond if you hold it from today until its maturity. And that's typically not what people are doing. They're holding portfolios of bonds. Those portfolios are changing over time. And so, as you say, the yield, the income you get on a bond portfolio can rise and fall. Now, an interesting thing happens when you get what people think of as excessive cuts to interest rates, because, of course, what the Fed does is it cuts short-term interest rates. The only way it's been able to control long-term interest rates, the interest rates that tend to be on treasury bonds for 5, 6, 7, 8 years. The only way it can control that is through actually buying those bonds. So what we used to call quantitative easing, and that, of course, was a tool that the Fed used excessively post the financial crisis, but aren't using at the moment. And so when we look at what's happening in the bond market, actually you're still getting a good yield above inflation on longer term bonds. So you're making real money on the longer term bond holdings you have, even when the income on short term bonds is and money market accounts, things like that, is declining. And so from an income perspective, you can still get a good yield on bonds, but the most important thing is not to be greedy at this part of the cycle. So sometimes happens is people say, oh, well, I can get, let's say, 4% in a 10-year treasury bond. I could get maybe 5% by buying bonds issued by companies, so-called credit or corporate bonds. Now, the challenge of those bonds are that although you will get that higher yield because you're accepting the risk of default, these companies are companies, they're not governments, they can go bust. Right. Then because you're accepting that, then you'll get a slightly higher yield. But those bonds tend to be more positively correlated with stocks. So when stocks go down, often these higher risk credit bonds also go down as well. It's not quite that predictable, but that is a risk. So they don't act as such a good brake in your portfolios. You have to be really careful about the role that bonds are playing in your portfolio, and then make sure you have the right bonds to play that role.
To match that risk that someone might have. Yeah. Well stated all the way through. Nothing to add to that. It leads to that discussion of diversification, of concentration risk that we'll get to. And right now, investments outside U.S. borders. Right now, the U.S. stock market is, just to use a term that you'll hear daily, overheated. Possibly overvalued in all. We do have a spreading out of companies, stocks within the U.S. stock market that are seeing positive returns. We're not so concentrated on technology, the AI bubble. So something that we've talked about in the past on these recordings, investing outside U.S. borders, increasing the amount of investment that isn't so concentrated in the U.S. So the concentration risk we'll get to in a minute, but talk about investing outside U.S. borders. How does Morningstar view that right now from a valuation standpoint? Is that the value area? What do you see outside U.S. borders?
Of course, Lou. So when we think about investing in stocks, then the two things are really important. The first is the quality of the companies that you're buying. And the US really has unrivaled quality companies, amazing companies in the US market. But even the best company can be a poor investment if you pay too much for it. And that's where we really have to think about the valuation. How much are you paying for the value of that business and its future profit stream, the future cash that you're going to get as a shareholder. And as we look at the global markets, we're seeing much better value outside the US. Now, not as much as we saw this time last year. So when we were talking about the markets then, the international markets had had a pretty terrible time for a while. And actually this year we've seen much higher returns, partly because the dollar's been falling as well. But there's still much better value outside the US. So we're seeing that value in Latin America. We're seeing it in some more emerging markets. We're seeing it in developed markets, particularly in Europe. We're seeing it in the UK. That's not just bias. There's some really few companies in this country. And so we're seeing better value around the world. The other benefit, and we'll come on to this in a moment, is that outside the US, many parts of the world aren't so focused on technology. And so you're getting different types of businesses as well. So if something does break in this incredible investment story that we're hearing about AI, then you're likely to get better diversification, different behavior of your portfolio outside the US.
Okay, thank you for that. And let's talk about AI. We are believers in AI. We've had our discussions about digital currency, crypto, whatever you want to define it as. AI almost is running parallel to that in investors' minds, that they're one and the same. They are not. The AI trade dominates news here. I can assure you. I know you're in England, so you just don't get any U.S. news, of course. Total sarcasm there. But anyway, the AI trade is really dominating the news. How much do you see risk being in that trade right now? Should there be a pullback? And I don't want to be so black and white about the AI trade as it's being presented to us right now. Your outlook on the AI investment, which we talked about last time, so you don't have to go back over, hey, this is like the internet. There will be some survivors and there will be some pets.com and that kind of thing that fall away. It's more about what is the warning sign, if you will, for artificial intelligence investing right now, that as you see it?
Yeah, so I think there's two things. The first is that the stocks that we all know that are leaders in AI. So obviously the biggest one we all know, ChatGPT, owned by OpenAI. That's a private company. But then you have businesses like Alphabet that owns Google. You have Meta that owns Facebook. These are all Microsoft, of course, investing heavily. You have some big AI names there, and those businesses don't look cheap. There's a lot of optimism in the share price. There's a lot of optimism in NVIDIA's share price, of course, is building a lot of the chips that drive AI. And so we're seeing optimism there. Now, optimism is not the same as saying something is very overvalued. It could be that the optimistic assessment is correct. And we're certainly not at that stage that we were at in 2000, the dot-com bubble, where valuations looked impossible from any angle. And so there is optimism, but that may be correct. Prices don't look crazy. But we're seeing this continued huge investment in AI, and companies are investing in each other. There's a lot of borrowing that's going on to fund these data centers. There's an enormous amount of investment. And so as that grows, then the probability that we're going to get that optimistic outcome becomes less and less likely, because as prices rise, then the outcomes have to be more and more extreme. So that is a concern. But the bigger concern is not that that's happening, but that the markets are so concentrated in that area at the moment. So we know that a huge part of the US market is concentrated in the small number of stocks, the so-called Magnificent Seven, which are very AI focused. But then even if you look at the US market as a whole, in the global stock markets, the US has a very high weight. So it's up near 70%. So if you have a globally diversified portfolio, again, the US is going to be very high. So again, technology behind there. But even when you go into other markets, so let's take the emerging markets as a whole, then about 9% of the emerging market index is invested in Taiwan Semiconductor, which of course is driven by AI. So there's AI throughout the investment ecosystem. So the most important thing that we're thinking about is not whether AI is in a bubble, whether it has much further to go. That's impossible to tell, and it's not absolutely clear at this stage. But we want to make sure that portfolios are well balanced so that if it's shown that those estimates are over optimistic, if we get some sort of pullback, that actually that doesn't dominate the returns for anybody's portfolio. And so that's the way that we'd approach it, not to worry too much about whether it's in a bubble or not, but just think about the influence it has in the portfolio. And if you spread out your portfolio more broadly, then what you'll find is that you may not keep up in the short term if some of these optimistic expectations kind of come to fruition, but you'll probably have a much smoother ride because if it does go wrong, if people are being too enthusiastic, you won't be so impacted by that.
I appreciate that, and you give me a great opportunity to talk about concentration risk, and I am going to dare correct you on one thing: when it goes wrong. Okay, because we've been at this long enough. We know it goes correctly and we know it goes wrong. Those two things are outcomes that we're sure of. Yes. Yeah, I jokingly for the regulators say all the time, I make two guarantees. The stock market will go up and it will go down. It's how we approach both of those outcomes that determine whether we will make money together or not. So with that, concentration risk, and I really appreciate you leading into that, Dan, because Morningstar is a really good partner to Tranquilli Financial Advisor and to our clients in that your methodology suits the methodology that I take to clients, which is to not only diversify where it is that we're invested with client assets, but also the companies that are managing those assets on a day-to-day basis. Morningstar being one of them, individual stock portfolios as we use them with Morningstar. Everyone can hear the passion, the intelligence, and the thoughtfulness that goes into your portfolios. But we're also spreading out risk through theories. Different investment firms have different methodologies. Let's say argued, because I'm from New Jersey and I'm Italian, so I argue. That's all there is to it. But I've argued for years, why does anyone have to be right? Why does it have to be one specific way of doing it correctly? Diversify the theory within a portfolio. Sometimes Morningstar is going to be far more correct than one of the other firms or several of the other firms, but then their turn will come and they'll be more correct. So we're not chasing the stock market, so to speak, in return. We're actually managing the risk through diversified theory. And I dare say that's worked out for all parties involved at this point. And I'm hopeful and confident that'll maintain its course. So with that, we are just at the 20-minute mark. Your time is always so respected and appreciated. We thank you for giving it to us all year. And you'll be back in 2026.
Absolutely. I'm looking forward to it.
Excellent. All right. So until then, a very Merry Christmas, Happy New Year, Happy Holidays in general, whatever you celebrate at home. And Dan, thank you so much for being a part of these great conversations for clients.
Well, thank you, everyone. And look forward to seeing you in the new year, Lou.